Hello friends, myself Savita Patil, Assistant Professor, Government Degree College, Kamalapur. In my today's class, that is under the bridge course part second, we should discuss. In my previous class, we have discussed regarding the bridge course, that's the financial accounting, the part first. In my today's class, we shall continue the part second of the bridge course. Now let us see the definition of bookkeeping. Bookkeeping is defined by Carter. Bookkeeping is a science and art of correctly recording in books of accounts all those business transactions that result in transfer of money or money's worth. Students, here we can understand the bookkeeping is a science because here under the financial accounting, that is that some principles are there. We have to follow the different principles. According to that, we have to record the business transactions. That's why we can say it's a science and art. That's a systematic of recording, correctly recording where in the books of accounts all those what we have to record, all those business transactions that result in transfer of money or money's worth. This is what the beautiful definition given by the Carter. And let us see another. That's bookkeeping is an activity concerned with recording, classifying financial data related to business operation in order to its occurrence. Okay. Here we can understand that bookkeeping is one of the important activity which concerned with what the recording of transactions and the classifying. That is what the financial data related to what related to the business operations, the day-to-day transactions which are occurred. That is what in order of its occurrence. Next, let us see. Bookkeeping is a mechanical task which involves that is collection of basic financial information, identification of events and transactions with financial character, that's economic transactions, measurement of economic transactions in terms of money. Here another thing we can understand that the bookkeeping is a mechanical task which involves, that is first thing is the collection of basic financial information, that is what are maybe the information which is related to finance that we have to collect. That's the first one. The next will be the what identification of events, that is what events means, events that whatever may they happen for in the day-to-day business, that is, and the transactions, that's how they should be with the financial character, and that should contain more economic transactions. And another thing is what it should be measurable, measurement of economic transaction in terms of money. Okay, this is what the brief, the information related to the bookkeeping. Now let us see the accounting process. Recording of transactions, that is as soon as transaction happen, it is at first recorded in subsidiary book. Here the first thing we can see, the journal is what it is called as an original entry book, it is called as an J book, it's called as a subsidiary book. Here as and when the day-to-day transactions were taken place, those transactions should be recorded in a book called the journal, which is also known as the day book. That should be recorded the chronology. Okay. Then the ledger. All the entries should be passed to the ledger, that is posted to the ledger. All journal entries are posted into ledger chronologically, order of time, and in classified manner. Then after the ledger where they will go trial balance. After taking all the ledger account closing balances, a trial balance is prepared at the end of accounting period for the preparation of financial statement. Here why there is a need for the trial balance means for the preparation of the financial statements, and after this we can go for the adjustment entries. All the adjustments entries are to be recorded properly and adjusted accordingly before preparing financial statements. Then after this we can go for the adjusted trial balance, that is it should be prepared. Then the closing entries. Then after recording all these, we can go for the preparation of the financial statements. Why we should prepare means to know the financial position of the business. Okay, this is what called as the accounting process. Okay, here we have to remember that in the accounting process, whatever may be the transaction, we have to record it: journal, ledger, trial balance, adjustment entries, adjusted trial balance, closing entries, and the financial statements. Okay. Now let us see what is transaction. Okay. Already we know that is a transaction is what transfer of money or money's worth. Let us see in detail. It means an event or a business activity which involves exchange of money or money's worth between parties. There should be exchange of money or money's worth where it should be exchanged between the different parties. The event can be measured in terms of money and changes. The financial position of a person, example, purchase of goods, would involve the receiving material and making payment or creating an obligation to pay the supplier at a future date. Transactions could be cash transaction or credit transaction. Here, we can understand that the transactions have been classified into different kinds. That is cash transaction, credit transaction, barter transactions, and the paper transaction. The different types of that. Then, when a party settle the transaction immediately by making payment in cash or by check, it's called cash transaction. In credit transaction, the payment is settled at a future date as per the agreement between the parties. But according to in business, there are two important transactions are there. One is the cash and the another will be the credit. And the cash transaction, the settlement will be done immediately, whereas in a credit transaction, the payment will be postponed according to the for a future as per the agreement between the parties. This is called as a transaction. The next will be the goods and services. Goods or services, they are intangible article or commodity in which a business deals. These articles or commodities are either bought and sold or produced and sold. At times, what may be classified as goods to one business firm may be goods to the other firm. Example, machine manufacturing company. The machine or goods are as they are frequently made and sold. Here, what the goods refer to that is the where the manufacturing has been taken place. That will be we can treat as a goods in business. Okay, but for the buying firm, it is not goods as the intention is to use it along the resource. That's a long-term resource and not sell it. Services are intangible in nature, which are rendered with or without the object of earning profits. Here, what we can understand that the goods is different and the services is different. Here, the services are provided that is to for maintaining the reputation also, and also it's not the main motor or objective behind the services, only the profit. Behind this, everything is income. Okay, then let us see what is the profit. The excess of revenue income over expenses is called the profit that we know. Then the loss, the excess of expenses over income is called the loss. Then the assets. Assets is a resource owned by the business with the purpose of using it for generating future profits. We already know the assets are classified into tangible and the intangible assets. Tangible means which we can see. Okay, example, that's a furniture and fittings, land and building, computers, vehicles, etc. are the examples of the tangible assets. Whereas the goodwill, patent, trademarks, copyrights, brand equity, designs, intellectual property, etc. are the examples of the non-tangible assets. Okay, then. Now we can understand the further that the assets has been classified into current assets. Okay, that is current assets means what here an asset shall be classified into current assets. That's why any of the condition that is it's expected to be realized. The first thing it's held primarily for the purpose of being traded. It's due to be realized within 12 months. Then it is cash or cash equivalent unless it is restricted from the being exchanged or used to settle a liability at least for 12 months after the reporting date. This is called as a current asset. Now let us see non-current assets. All other assets shall be classified as non-current assets. Example, machinery held for a long term. Okay, means what here the current under the current asset short term will come within the 12 months, but non-current assets are they are called as a long-term assets. Then let us see the important aspect, that's the liability. It's an obligation of financial nature to be settled at a future date. It represents amount of money that business owes to other parties. Example, when goods are bought on credit, the firm will create an obligation to pay to the supplier the price of goods or an agreed future date, or when a loan is taken from bank. The obligation to pay interest and principal amount is created. Means what is the liability is it's an important obligation of financial nature to be settled for the future. In this also we can understand the current liabilities. That is what is means it is expected to be settled in the company's normal operating cycle. It's held primarily for the purpose of being traded. Then it's due to be settled within 12 months, and the company does not have an unconditional right to defer settlement of the liability for at least 12 months. This is what the current liabilities. Then let us see what is the Working capital. In order to maintain flows of revenues from operation, every firm needs certain amounts of current assets. Example, cash is required either to pay for the expenses or to meet obligation for service received or goods purchased. Okay, this is what called as working capital. Working capital we can understand with the help of the gross working capital is equal to total current assets. The long term internal liabilities plus long term debts plus the current liabilities minus the amount blocked in the fixed assets. If you done this, you can get the working capital. Now let us say the capital. It's an amount invested in the business by its owners. It may be in the form of cash, goods, or any other asset with which the proprietor or partners of business invest in the business activity. Students, now we can understand what is the meaning of capital. It's an investment made by the owners, that is in the form of cash, in the form of goods or anything. Okay. Then capital of owners is a liability which is to be settled only in the event of closure of transaction of business. Drawings. It represents an amount of cash, goods or any other assets which the owner withdraws from business or for his personal use. That is drawings refers to what that is the withdrawal of cash or goods by the proprietor for his personal use. That may be the he may pay the life insurance premium. He may be taken the goods from his business for his personal use, for his personal use purposes, etc. This is called as in drawings. Then the net worth, it represents the excess total assets over total liabilities of the business. Then the non-current investments. Non-current investments are investments which are held beyond the current period. Then the current investments are the investments that are by their natural readily realizable and intended to be held for not more than 1 year. That is, it's called as an current investments. Then the debtor, the sum total or aggregate of the amounts which are the customers owed to the business for purchasing goods on credit or services rendered or in respect of other contractual obligations. This is called as a debtor. Then the debtor, under that we can the goods debts is there, the debt which are sure to be realized or collected from goods debts. Doubtful debt. The debt which may or may not be realized are called the doubtful debts. May or may not. Okay, that's doubtful. Then the bad debts which cannot be realized, they are called as the bad debt. Now, let us see the meaning of creditor. A creditor is a person to whom the business owes money or money is worth. Example, money payable to supplier or goods or provider of service. Creditors are generally classified as current liabilities. Okay, the creditor means what? He is a person to whom the business has to pay the money. Then the capital expenditure. This represents the expenditure incurred for the purpose of acquiring a fixed asset, which is intended to be used over long term for earning profits therefrom. Example, that is amount paid to buy a computer for office use is a capital expenditure. Okay, here under the expenditure we can classify the expenditure into the capital and the revenue. Capital means what is a huge amount which is incurred. That is, at times expenditure may be incurred for enhancing the production capacity of the machine. This is also be capital expenditure. Capital expenditure forms part of the balance sheet. Let us see what is the revenue. Revenue, this is represents the expenditure incurred to earn revenue of the current period. The benefits of revenue expenses get exhausted in the year of the incurrence. The examples of the revenue expenditures are repairs, insurance, salary and wages to employees, travel, etc. Okay, then the let us see that's what is the meaning of the balance sheet. Balance sheet is the financial state position of the business entity on a particular date. That is, it lists all assets and the liabilities and the capital. Okay. Here, the why the balance sheet is balance sheet means what? Means first let us understand it's a financial statement containing the assets and the liabilities, and why it is prepared means it is prepared to know the financial position of the particular business. Okay, it's important to note that this statement exhibits the state of affairs of the business as on a particular date only. It describes what the business owns and what the business owes to outsiders and to the owners. It's prepared after incorporating the results, profit or losses of income statement. This is what the important things we have discussed in my today's class under the budget course. These are the important various aspects we have understood, and each and every the students must go through with these four important points that basically has to understand the fundamental things before going for the financial accounting in detail. So I think you have understood my today's class. Thank you. Have a good day.